Roll, everyone's okay. Well, good morning. Thank you, Juan and the Grimaldo team for having me. I had the pleasure of meeting Juan probably a couple of years ago. I actually bought a home from him. I think many of you guys and ladies are there for a reason to build your potential rental portfolio and work on what I call passive income to live your best and highest life. I'm originally from Detroit. I came out to the Valley 22 years ago. Didn't own any real estate. Was always enamored by the power of real estate, the way we control it. And I started buying homes using OPM, other people's money. And we'll talk about that much further this morning. So I didn't come from a huge amount of wealth. I had cousins that were in the business, and I was what's called the human capital. I came out, did the work, rolled up my sleeves, went out in the field, met with great agents like Juan and other agents and investors and wholesalers in rooms like you're in today to start letting people know I want to buy real estate, I want to flip properties, and I want to retain homes for rentals so that I can work with that passive income. Does anyone in the room play Monopoly, I'm assuming, or have played Monopoly? I can see only a couple of people on the screen. Hopefully people have played. What I like to say is I'm living and I want you guys to live the real life Monopoly in your life, right? It's fun to play the game, but it's even better to really live and play the game with real money and see it real time and live your highest and best life by being in control. So over 22 years, I've amassed a portfolio of 9 figures in terms of valuation, just over $100 million in single family homes, no multifamily, no partners, just myself in terms of valuation by building it one home at a time, one relationship at a time, just like being in the room today, speaking to your neighbors, speaking to the agents, the loan officers, title companies, and letting people know that you too want to build, a portfolio one property at a time. So I was acquiring distressed assets, building these relationships, flipping, so I can get that disposable income and that liquidity to then buy my own assets free and clear. And then once I bought those homes one at a time, finally the banks allowed leverage, meaning they would loan against those properties or have lines of credit. I took those homes and pledged them to the bank where they would give me those lines, and I would use those lines to then buy new assets. So it's all about playing what I call the long game, the delayed gratification game. In America, the number one addiction is sugar, right? And probably cocaine, similar thing. What we call that quick fix. For me, I like to say, stay away from the sugar. If you look at the best diets and you look at the healthiest people in the world and the greatest investors, the Warren Buffetts, they're playing the long game. They're setting it and forgetting it. And so many people want that quick, oh, I want to make 20%, 30% tomorrow. The game truly doesn't work like that unless it's a scam. There's no really such thing unless you're absorbing so much risk where the downside risk is far greater than the upside potential. And so you need to find assets like real estate, in my opinion, and I'm not some financial advisor or anything else, even though I've worked on Wall Street, that will enable you to achieve those goals. So what do I look for when I'm buying deals? I'm looking for equity. It's very easy to go buy any real estate. That doesn't mean anything. You want to buy what I call on 4 pillars. So if you want to extrapolate anything from this morning, I would look at the 4 pillars that I look at. Number one, when I buy that asset, is it worth more than what I'm paying? And I mean significantly more. I typically like to buy deals at 75 cents to 80 cents on the dollar, depending on the amount of improvements needed. After I stabilize it, my meaning putting in improvements, carpet, paint, flooring, roofs, ACs, whatever it is, landscaping, I still need to have equity at the end of that stabilization process. That's what's building your net worth. In addition to that, and that's also enables you to continue to grow and scale. So for instance, I like to use a simple example. If you bought a home of $300,000 and you have 15% equity at the end of it or 20% equity, you're going to be, all in that thing at 250, 260, whatever it is. You can effectively take those same dollars, go to a bank, refinance that to get that additional equity out of it to continue to grow and scale your portfolio. That's why equity is the number one component that I look at when I'm acquiring deals. Again, it's very easy to go on the MLS and say, oh, I just bought 5 houses. What happened to your net worth after you acquired those homes? Probably nothing because you just paid retail. Effectively, it probably went down because if you had to dispose of those 5 homes tomorrow, you're going to be underwater after you pay commissions and closing costs and stabilization and carrying costs. So equity is the number one factor that I look for in acquisitions. Number two, when I stabilize that deal and I go to rent out that home, because again, we're playing the long game, we're not talking about flipping per se, and we can, I'm happy to answer any questions. What type of cash on cash return are you going to get by buying that deal? For me, I look at 8 to 10%. It's funny when you talk to other people in the world, like I only buy 15% or 20%. Those deals don't exist here in Arizona. They may exist in, inferior markets. But if we're just specifically talking about Arizona, today's, yields and cash on cash returns, if you will, you want to aim for that 8 to 10, and tens are very hard. Eight's very achievable. So that means that if I can get debt less than that, you're arbitraging, you're making the difference between whatever you're borrowing and that yield by putting a tenant in there. And again, over time, we believe that's going to go up because rental rates have continued to rise with inflation and cost of goods sold and things of that matter. And that's why, again, playing the long game, whatever your yield is today, because your basis is going to be fixed, you're buying it today, ideally that asset's going to appreciate, of course, over the long haul, 10, 20, 30 years, but also that return, because the rents are going to increase, your return over time is going to increase. So that's really important. Number three, can I buy it less than replacement costs? So if you really look back and you figure out, you speak to contractors, how much would it cost, Joe Blow, to build this home? And how much is the land? And how much does everything cost? And what is the cost of capital to get this thing fully erected and constructed? If you can buy that asset less than replacement cost, you already have automatic value. Super, super important. So when I'm looking at that, those are three main factors. And lastly, one of the most important, which I say when we're playing the long game, the delayed gratification game, the non-cocaine, the non-sugar game, right? Really the health game. Is this going to be a legacy property? I think a lot of us are here. Looks like a younger audience in there, and I got some younger people in Juan's family and whatnot. We talk about building those legacy properties. Is this an asset that you want to own to pass on to your kids, your grandkids, your dogs, whoever that may be? And if the answer is no, because it's on a major road, you don't feel safe going to the neighborhood, regardless of the other three things, whether you're getting equity, your cash on cash return, or you're buying less than replacement cost, I'd probably advise not to buy that deal. You want to feel comfortable in that asset class. And ideally, again, playing the long game, can you stabilize it? Do you want to keep this for your generational wealth? Nobody really talks about that. And I think that's really important. So when I'm buying a deal, I'm not just focusing on one exit of, okay, I'm going to buy this deal, I'm going to flip it, and I hope to make $20,000. No, if I decide to do that, great. But it's really important to have multiple exits because of the equity play and having equity in those deals. You have the ability to pivot and do whatever you want, whenever you want, if you needed that money, which is a great thing. You never want to buy a deal to only have one exit. I like to focus, and I call it contingency planning. If we get another COVID, if rates go up to 20%, if there's no sunshine for 30 days and you go to the beach, whatever. I watch a weather report, I'm going on vacation, it shows clear skies, no chance of rain. The contingency plan would be bring the umbrella, bring the extra food, bring a lighter in case your car gets stranded there. So when you're evaluating investments, it's very, very important to have what I call contingency planning. What are all the different ways we can get out of this? What are all the different ways we can make money? If the worst case scenarios happen, are we prepared? I know partners and everyone else come from military background, police backgrounds, military. They're always contingency planning. What if somebody's in the corner? What if somebody's hiding behind the bed? What if the enemy is over here? They're already going through simulations. So I think that's a good analogy in terms of investments to plan for what if this happens? Are you prepared? So very, very important. So those are the four factors that I look at in deals. And how do I find these deals? The same reason that on a Saturday morning, most people want the sugar. They're out right now, eating fat breakfast at an unhealthy place. We're here because we want to play the real life Monopoly, and I respect and I value that. That's why when Juan calls me, and I value that relationship tremendously because he's an honorable and a really good guy and a smart agent, I want to show up. It's easy to say no to things. It's easy to run the other way. It's easy to be comfortable and lay in bed on a Saturday morning. But we're here, and I've been uncomfortable my whole life because I'm not a complacent person. When somebody asks for an opportunity, you always want to say yes. Doesn't mean you have to commit to buy something, but it's really important to show up to understand the opportunities because you're never going to know who's sitting next to you in that room. It's not about me. It's not about Juan and his partners. It could be the other person next to you that maybe they don't want to buy the deal, but they've got capital for you. These are motivated people in these rooms that you want to engage with and create synergies and joint ventures with. So how do I go from 0 homes to just under 300 homes in 22 years? Yeah, obviously I didn't have tremendous cash and all that because I'm playing the long game and I'm constantly in perpetual motion, marketing, showing up to these rooms, talking to 1,000 Juans and great agents and wholesalers and letting them know I'm a buyer. Money will always follow a good deal. If you find a good deal below market, that's off market or it's on market, and you have that first look because you have those insider agent relationships, the money will always follow because you're what's called the human capital. we're the horses in the race. A lot of people don't want to ride the horse. We're willing to get on that horse, but there's a lot of people just want to be in the stands and watch with their binoculars and play that passive game and bet on your horse. So how can you go about raising? If you have no money today, and some people are like, Zach, I don't have any money, I can't do real estate. Of course you can, because you're the ones willing to put in the work. So what you need to do is raise private money. When I talked about early on the OPM, there's a lot of ways to skin the cat. You can use OPM, meaning that, again, other people's money, and give them what's called equity. So you stabilize the deal, you manage the deal, and you give them 20, 30, 40, 50%. In the beginning of my career, I gave up 50% of the deal. People would say, you're crazy, 50%, but I'd rather have 50% of 100 million than 100% of nothing, right? So it's easy to think, I want to be greedy, I'm going to give a 20% split. Any intelligent investor that has disposable income, the deal has to make sense. You can run it multiple ways. What I did, again, is I never took a management fee. I never got paid any money up front. I played the long game by getting paid on the back end. So when we bought assets, I was flipping with that OPM money. That way there's a clear defined exit for those deals. We would buy the deal. I would manage it with my crews. I would use I'm a licensed agent, which I think is very important, or align yourself with a great agency. Obviously, you got the Grimaldo Group to then help you manage and facilitate the exit on there. Once we exited, we split those profits down the line 50-50, and I use those monies to roll into my next deal. It's called the domino effect of money. One domino falls, and then the next one, it enables you to grow your net worth one domino, one home at a time. So that's what I did. I played that long delay gratification game on those exits. And basically, when I sold into the market and we were very profitable, I pay off those investors. You treat them very well, have good accounting, good communication, good engagement, and effectively you're growing your wealth together. And I would use my money again to buy those single family homes unencumbered until I could get net bank debt and leverage. And then it helps you streamline, your net worth in a faster pace. But again, even today, I still engage those early investors, those early adopters that invested in me, because you never know how big of an asset deal or how big of an opportunity comes your way, right? I've looked at 10 million. I closed recently on a $6 million deal. I did that one myself with some bank leverage, but I could have easily called the partners early on that invested in me and said, hey, do you want to invest in this deal? Here's the opportunity. This is what we're doing. I'm still going to give that 50-50 split, because greed does not make sense in the long game. You always want to incentivize your investors. I use a word called consultation. It's very important when you're talking and raising money to ask the people, what are you looking to achieve? Most people these days, and I coach and talk to a lot of young investors and older investors, and they say, I'm offering a 10% return and this and that. I said, slow down. You need to understand your target market and ask them what they want. What is your time frame for investment in your deal? When are you ideally wanting your money back? What type of liquidity do you have as an investor? Do you have the time frame so that we could do a long deal where we're doing a value add or we're building new construction? You really need to clearly define what is their appetite for a 6-month, a 12-month, a 2-year investment. Do they want to hold this asset long term, or do they just want to be in and out until you stabilize and refinance? So you always want to, before you offer returns to this OPM to these passive investors, it's very important to consultatively understand what type of returns are they looking for. You'd be surprised. We think, normal hard money is 10, 11, 12%. There's a lot of people money that are sitting in cash, right? And this is where it gets sexy. And you say, I'm going to give you what's called the first deed of trust on my asset. So there's no other leverage. They're not subordinating the debt, meaning they're not in a second or third position behind anyone else. It's the best position to be in terms of asset protection. So when you're raising that money to Joe Blow and Mary Jones, and you say, you're going to be on that first deed of trust. If I don't pay you on this time frame, you can foreclose and own it. And by the way, we're buying it at 60 cents on the dollar. That's a very good investment position to be in. It's the first position. Does that make sense to everybody? So again, by doing that, it just enables that win-win situation. Again, going back, we think, 10, 11%, but a lot of people in cash, they may be willing to take 5% or 6%. They also may be willing to delay those interest payments until the culmination of the project. So we are in the driver's seat. We're the ones creating that investment instrument based on the needs and wants and desires of those individuals. And that's where I found great success, by slowing it down, having very good, concrete, consultative conversations with these investors, understanding their time frame for investing, what type of desired returns. And you could do what's called, and I love this one, a hybrid deal, meaning I'm going to pay you a preferred return of, let's say, 5%. You invest 100,000, you get the first 5,000 on the investment. And at the very end, we can split profits 80-20, for example. So if we sold the deal and I bought it for 100,000 and we made $7,000, for example, they get 105 back. And then the other 2,000 remaining would be split based on whatever proration you guys decide in terms of an equitable split. So there are a million ways, I could talk about this for hours, to structure these investments. But it's just super important. I really want to whet your appetite to think about, the ability and the abundance of opportunities for you to buy deals, whether you have your own money, you're in a great position, but nobody has infinite money, including myself. So it's important to say, if you want to build a portfolio of 10, 20, 50, 100, hundreds of homes like myself, how do you get there? Well, you get there by utilizing a hybrid approach of your own capital, other people money, bank money, and being in perpetual motion, manifesting, projecting all these opportunities. The other thing that I find super important, I don't know if any, hopefully a lot of you guys have social media and different opportunities. You can't be a hermit. Money is not made, the money is made by showing up to events like this and being in that perpetual motion. But you got to project, you got to manifest. A lot of people I know, they say, I have a hard time raising money. I say, cool, what's your Instagram? What's your YouTube? What's whatever? They don't exist. You have to be out there and being top of mind mentality, because when someone's betting on you as a horse, they want to see you on the track. They don't want to see you sitting in your bed or having a low energy conversation. You got to be confident in what you're doing. You got to be top of mind. You got to be out there like the Juan Grimaldos. That's why they're successful, constantly marketing, showing the homes they're buying, because now you as a buyer or an investor, whatever that may be, you're seeing them top of mind. With a high degree of confidence, they're out there day in and day out practicing what they preach. And that's a better bet than somebody who's just sitting in bed, obviously. So if you're willing to get in the game, start looking at assets, going through these simulations, looking at other investments. Like, again, I bought deals from Juan, and we can talk about that deal on Alex, 7894. I remember every deal. And why did he know when he called me, hey, Zach, I'm flying to Spain and I got this deal. Excuse me, do you want to buy it? And he already underwrote it in 3 seconds. I looked and I said, yeah, I'm a buyer of that deal. Why? Because it met those 4 buckets. A good agent will break that down for you to really make you understand, okay, this is a long game asset. This makes sense on multiple levels. It meets those 4 criteria. I'm going to get my 8 to 10%. I've got my equity stabilization. It's a legacy property, and I can buy this less than replacement cost. It's kind of a dummy-proof deal if you leverage those pillars when you're evaluating these assets. So that's the type of stuff that I look at. I could talk on and on and on, but again, when we talk about the word consultation, which is so critical to my business, I really want to listen more and get back. You guys are all here for a reason. So I really want to open it up. That's kind of my background. That's what I've done. I'm passionate about it. I love it. Clearly I get energized by even engaging on it because it's the greatest business in the world. And lastly, just one more thing before I open up for questions. It's interesting, right? I believe that we're our best captain of our domains for our financial security. I've invested with a stockbroker. I've worked on Wall Street. I think it's all BS. Those people that are managing our money, do they really care? If that stockbroker calls me and I still have a little bit of money with them because I'm not paying attention to the equities as I am in my real estate portfolio, we will always outperform someone else because nobody cares more about your financial future than yourself. Right? Those people taking their 1% fee, I hear from them once a year. Do they really care about me? Do they even know what's going on in my life? Do they understand my utility or need for my money? Did I just have a kid? Did my dog have cancer? They know nothing what's going on. And that would be critical if you're a financial advisor to understand the utility of the person you're managing the money. Maybe they need some, less risky investments. Maybe they need shorter term liquidity and put me in bonds. But unless they called me and consultatively engaged me on a monthly basis or weekly basis, there's no such thing as too much communication unless that investor, that individual says, hey, it's too much. This is the type of communication I need. So again, we are our greatest champion for our future. Nobody cares more about our future and our ability and our financial wealth than ourselves. And that's the beauty of real estate. It's tangible. It's local. I don't invest out of state. You can drive by it. It's a stable asset class that enables you to sleep at night, that we can leverage, that we can continue to build that game of Monopoly on an exponential level, utilizing delayed gratification, strategic relationships, and again, playing the long game. So that's my story. I really want to open it up for Q&A and address any questions, concerns, any hesitations anyone has, so I can serve you to the highest level.
Awesome. Is this good, guys? Good morning. To all those just arrived, thank you so much for coming. Zach, I love your energy, man. I love your passion for real estate. And I'm on the same boat. You know, we love real estate because of that. You can create wealth for generations. One question that I have for you is, okay, you're at, how many properties are you at right now? Did he froze?
Yeah. Just under 300, 287.
287 homes. What was the first step? How did you get to the first house?
The first house, when I flew out here and didn't know anybody, I remember calling in the newspaper for distressed assets, right? We didn't have the Instagrams and Facebooks. There was none of these. I didn't have access to the MLS right out of the gate. I saw an ad. I called on it. I ran the numbers. I had the OPM for my cousins, the other people's one, at 50-50 split. And I took a calculated risk. I think it's very important. I didn't start with some $2 million house. I like, and I encourage you guys to stay under that 450, 500 range, because that's the target market in today's market. My first deal was 60,000 on Rozier in South Phoenix. I remember, I think it was 2102 East Rozier. It was in South Phoenix. It was kind of a tough neighborhood, but it just made sense. It was low risk. I could absorb that risk. I could anticipate how much money I projected to put in there. I think I made $15,000 on that first deal. I bought it from Lebrose Realty and from an ad in the newspaper. And again, one home at a time. You're going to learn from one at a time. I don't say go out and go buy 10 homes. Start with the lower income one. Or if you're not experienced in major construction, you could do a deal like we did on Alex that didn't require, $100,000 in rehab. It required $20,000, carpet, paint. I ended up doing a kitchen. I always like to spend the money to make the money because I'm going to own this long term. I'm all about putting money into my asset classes, and I'm not fearful of it.
Love it. And how did you scale? What was the, so first of all, because you said you were in Wall Street, did I hear right?
Yeah, I did. I worked for Prudential Securities trading options. And what I realized by working there is, one, I don't want a corporate job because you're making all this money for an institution. And two, us as individual investors, it's the institutions that are making the big moves and affecting the market. That's why real estate is so great. We're controlling our own destiny. Whereas if you're investing in a stock, what control do we have of that equity? Zero. By the time the insider traders and the rumors and the balance sheets come out, all the insiders already have access to that information. They've already sold that. And by the time we get wind, we're the last people to act and lose. So the beauty of real estate is we're controlling the destiny our own time, not these institutions, not these big billionaire players and trillionaire companies and the Blackstones. We're at the forefront. We do what we want when we want. And that's a beautiful thing, to not be manipulated by outside forces and factors.
That's huge. Questions, you guys? Do you have any questions? We have a couple of investors here. One super young. He bought his first home as a wrap, right? And then I have Jose here, who's been buying property for a while. His story is amazing. I mean, how many properties are you up to right now?
Five again.
5 homes?
After I sold 9.
I know he sold 9 and he owns 5, but he's doing seller carrybacks. He's now being the bank, so it's pretty cool. And then we have Janet, also owns her first rental property, and little by little, she wants to buy her next one. So we have people that are playing. We're starting here. I own a few rentals too myself. And anybody has any questions for him? I think this is fascinating. Okay, go ahead.
What is your recommendation for someone who's just starting, like with no knowledge of real estate? I just have my uncle, whatever he's mentioned, and my background is completely different. What is a recommendation? Where could I start?
Absolutely, great question. One is I would take like a last investment that Juan or someone from his team sold to one of the other investors. And I always like to say, do a simulation on that deal. Start delving into, why does that deal make sense? Why did that investor buy it? They already know the numbers. Ask those agents, hey, Juan, talk to me about the last investment deal. We could look at 7894 Alex. Why did Zach buy that deal? So you can simulate and really get comfortable understanding it. It's like going into the casino and saying, I've never played blackjack or craps. You're not going to walk in and sit at the high rollers room and play and you don't know the rules. Go up to that table, watch the players play, read the book, and how does blackjack work? Watch and see, and then simulate what you would do based on that player sitting on that chair, and make sure that your actions align with that player, and run through enough simulations till you get comfortable to then actually put the money on the table, right? So it's really important to take the time to run those simulations, delve into many deals, really understand. And while you're doing that, start having just basic conversations with your sphere of influence. Hey guys, I don't come from this background. I just went to this meeting. I'm super intrigued. I'm thinking about raising money. What is your appetite for joint venturing? What's your liquidity? Do you have any interest in investing in what I'm going to do? So I would start again, simulations, having basic conversations and projecting and kind of whet people's appetites based on the information you're acquiring to get them excited to invest with you, right? You want to be confident. If you don't know what you're doing and you're going to raise money, say, hey, I don't know what I'm doing, I'm going to get started. No one's going to invest. But then you say, hey, I've just underwrote 100 deals. These are the type of assets I'm going to buy. You can put together a basic presentation. Juan or anyone from the team could review it to say, yeah, this makes good sense. Then you get rocking and rolling. So get comfortable. I'm not somebody that's out there, you don't know what you're doing, start buying houses. No, that's a very good question. Start simulating, going out in the field, looking at, these flip properties or the type of assets that you desire to buy. Walk in those houses too. Start driving the neighborhoods and look and say, hey, Cruz, how much money did you put in here? What type of capital should I allocate for a 3-bed, 2-bath in Goodyear? If you live in Goodyear and you like a 1996 home in a HOA community, what type of money should I allocate for a basic remodel? And start running those simulations. Look at 10 or 15 of those deals so that you are super comfortable. Again, we talk about contingency planning. What is the worst case scenario? Did I lose you? There we
Can you
go.
hear me? Is that
Now
better?
I can. Yeah.
Okay. So I say get as much information as possible. I know Chip has a mentor that has been helping him out. I'm here. There's plenty of books to read, right? There's so many avenues, and you're doing the right thing right here. By being right here, you're going to learn one nugget or two. Like we've been talking for a little bit with, I love talking about you because you're super young, and he just took a chance and went for it, and he's now owns a rental. And he put a little bit of money down and got the deal done. Sergio, he's our lender. I brought him a deal, right? Sergio, this is a no-brainer. I can't take it right now, but take it. Was that a good deal?
Absolutely.
Right? So it's just a matter of being exposed to it. I know Alexis over there is doing crazy stuff too. And he's super young. I mean, he started I gave him a book. He became intrigued and he continued to read. Now, you guys know I'm huge about books, right? And that's the reason. Why? Because you can learn from others while it will take you so much if you did it yourself, right? So I think that's great advice. Thanks, Zach, for joining us. Who else has any more questions? I want to take advantage of this guy because he's super busy, tons of knowledge, and it's a good opportunity for you guys to gain some great knowledge.
Hi, this is, sorry. Oh, you guys went out. But my question, this is Frida. I was just just wanted to know, are you familiar with, like, there's different organizations that have like applications that supposedly assist you in finding like motivated buyers and sellers and tells you if the property is worth investing, that sort of thing. Are you familiar with that? And if so, is it legit?
That's a great question. There's a million different programs, if you will, from batch skip tracing to these people selling leads and all that stuff. I would say if you're first starting out, I would avoid that. I don't pay for any of that at all. Simply what I do is I network and I let people know I've got capital. I want to invest. This is the type of assets I'm looking for, and projecting that by showing up and telling the agents that kind of will be your workhorse, right? You're the buyer, you're engaging them to employ them for free, effectively, right? It doesn't cost you anything to be represented to find you those assets. So I would dissuade you from that because I think a lot of it is probably scams. That data, if it's out there for everyone, everyone's chasing the same data. The reality is those houses are going to get bid up if they're high equity. For example, you're talking about buying this, what's called high equity, meaning maybe they own, they have a debt of 20% on that asset. Maybe they're a motivated seller or it's a foreclosure list. Everyone is facing that. I would avoid that and go and let the people do all the work, the wholesalers who get it tied up, and say, hey, it's Frida, right?
Yes.
Hi, Frida. Zach here. I just got a foreclosure. It's got 20% equity. It needs 5,000 in work. It's ready to go. Are you able to close in a week? And you would say, wow, that's definitely meets my list. I want to go out. I need to walk it. I would never buy anything sight unseen, especially and a lot of early investors say, oh, send me the contract. It meets the criteria. No. Trust nobody other than your top agent. But even so, show up at the asset, walk it, maybe bring your contractor to truly evaluate it. Are these numbers accurate? Did they hide a structural crack? Is there something that we could be missing? Remember the contingency planning to really
Mm-hmm.
into it to make sure that it's as represented. It has the criteria that we're looking for. You want to take emotion out of the deal. It's easy when someone says, I'm just getting started, I'm excited. A very experienced wholesaler is going to take advantage of that exuberance and excitement.
Yeah.
I got you a great deal. Here you go. And you're like, oh, I just bought one. I see it all the time. Like, you just bought a retail deal. Excuse my language. It's shit, right? Because over exuberant and they're capitalizing on your excitement and not sticking to the facts, right? Does it meet these terms? What are the numbers on it? And being conservative and always estimating 10 to 20% more than you even anticipate for repairs so that you're getting a deep, deep deal. You always want some cushioning on any investment.
Oh, thank you so much, Zach. I appreciate that.
Of course.
Just so you guys know, last week, thanks, Zach, for that. We had a meeting. My microphone's working, right? We met with a client on Saturday. Raul was here with me, and they spent $20,000 on a program to learn how to buy property. They got scammed, right? I mean, it's a lot of money that you don't have to spend. You have us as resources. Take advantage of that. Again, there's tons of books to read, but again, getting the exposure and by being here and going to these events, I meet with Zach every quarter. This last time I had to leave earlier, but you get in front of all these masterminds, right? That share what they know, and then we bring it to you guys. So just know that we are in the trenches. We're working every single day doing deals. So we know the market, we know the prices. So if you guys are looking into investing and getting into this, we have access to those deals. And by partnering with Zach and all the circle that he brought me into, we have access to those kinds of deals, and Paulina's going to start working on them, sending them over to those people that are interested. And these deals don't go to everybody because we want to make sure that the people that are in that realm are able to move forward and purchase. So just know that you have access to that. Go ahead, Zach.
That's a great point. That's a great point, Juan. So, Freda, going into your question, what you want to do is project, again, those what I would utilize, my pillars, again, formulate however you want. That's what works for me. It would work, I think, for anybody. And saying, okay, I'm ready to go. And you convey to Juan, all right, here's my time frame. Here's the capital that I have, or you have a lender and what's the leverage look like. And then he can go into our circle because we deal with the number one wholesalers and the number one acquisition buyers in Arizona. And we always say, and I talk to all of my top agents when I do a deal, I say, Juan, what clients do you have? What do you need? How can I serve you? Because we always get that first look at the deal. It's not some daisy chain where it's passed on 10 people and there's no equity again, because that deal wouldn't work for you. The deal has to work. He's going to bring you opportunities that fit that criteria and narrow it down for you. And then you evaluate it. And if it's a green light, it's a green light and you move forward, So that's the beauty. I would ask the young kid in the front you were talking about before, the young guy, and ask him, what is it like getting that first check, right? That was the greatest feeling on my first investment. I remember it was a Section 8 home on Turney. I had these little cheap condos, and I would wait for the government check from City of Phoenix to come in the mail. I was so excited, $900 on a $30,000 investment. I'm like, I've made it, right? And then it whets that appetite one at a time, and then you get two of those, and now it's obviously no longer in the mailbox, but it's via Zelle or the direct deposits. There's no greater feeling by having that control and the expectation of that mailbox money coming in. That's what this is all about, controlling the controllable and really setting yourself up for, great success in the future.
Definitely. One of the things that I can also share from what you shared, Zach, is this is a long game. A lot of people want to get in, get rich quick. It doesn't work that way. It would be awesome, right? How long have you been in the game, Zach?
2 years.
22 years?
Yeah.
Is that an overnight success, huh?
Not at all. I've been grinding every day. I work 7 days a week, even today.
Yeah. I mean, and it's passion, right? Like you have passion for what you do and passion for helping people. This guy is the most selfless person I've ever met. Like he loves to give. And when we meet, he's always about, what do you need? How can we help you? Right. And that's how I want to learn from this guy and share that with you guys. And I don't know if you're supposed to know me. That's who I am. I want to give back to you guys. You guys have helped us get to where we're at. You guys have fed our families and many other families. So we're here for you and give back to you. And again, Zach, thank you so much for your time, for spending it here on Saturday morning. And we have a couple more questions before we let you go, but we're grateful to have you here.
Zach, how's it going? So one of the questions I had was, you mentioned Section 8. So what was your experience with that? Because I was learning about it, I see that there's different markets in real estate, and that one's the one that really caught my attention.
Yeah, great question. You want to evaluate any rental or investment, if you will, based on market rents, right? So Section 8 is a government subsidized program for people. We call it more of a guarantee. They don't always pay all of the rent, but traditionally, based on the qualifications of the applicant, you're guaranteed money from the government, right? The government's not going broke anytime soon. So I have maybe 8% of my portfolio, maybe 7% is with HAP or Section 8 housing, whereby those tenants, they don't, have the greatest income. They qualify for subsidized rent, and the government then, in conjunction with those tenants, pay your rent together. You're not really getting any premium. So the most important thing when you evaluate that is to understand what is the market rent, because they're not going to pay you more than the market. You need to provide them comparables for that rent. But the nice thing about a Section 8 tenant is longevity. Most of my Section 8 tenants, they don't like transitioning to another home. Once they get in there, they want to stay. The other nice thing is the government mandates that there's 2 times a year and inspections to make sure that they're maintaining the home and not distressing. If they do, they lose their voucher, and that's beneficial for you. The downside of a Section 8 or a HAP housing is by the time you market it, by the time they do an inspection to move in, you could lose 1 or 2 months rent when you could have just gotten a regular tenant. So you want to evaluate time frame for move-in, making sure the home is up to obviously compliance and safe and sound for those individuals living there, and the delay of them entering. So ideally, if you got a home in escrow, I would start that process immediately by marketing it, right? You always want to be what's called proactive versus reactive. So if you plan and say, you know what, I want to try the Section 8 thing out, and Juan sells you a deal, wherever, and it's a clean home, and you have a 30-day close, I would be proactive in marketing, saying, hey, willing to accept Section 8. You never want to say only Section 8 because you're discriminating. Say open to Section 8, or you can post it on the Go Section 8 website and research where you can market for those types of tenants. And then you could start touring them through that asset even before you close. That's one thing that I love about real estate, right? We're controlling it even before we own it. That's the ultimate arbitrage leverage play, by really marketing and doing something for something we just have an equitable interest in. You haven't even closed and you're already marketing it. That is fun and that's exciting. So at that point, if you can get the tenant in at the same time in which you close, you lose 0 days, in terms of carrying costs and vacancy. So I kind of play that monopoly game with myself of how fast can I turn a property, right? Like it's an internal thing, it's a competitive thing, and having fun with it. How quickly can I transition and stabilize this asset with the tenant, or sell it or wholesale it or whatever it is? It's a game. Have fun with it.
Awesome. Questions? Any other questions? No? All right.
Take advantage.
Exactly. This is huge.
I'm
So
here. I
ready.
love doing this. I'm not, you could ask me what you perceive to be the dumbest question in the world. I probably ask that question that you have. Shoot, there's nothing. Ask me anything you want. Happy to help.
Well, I'm an investor, Zach, and one of the reasons I love real estate is because of the tax advantages. You want to share just a little bit of how depreciation has, do you pay taxes by the way?
I pay a lot of taxes. It's funny. A lot of these gurus out there say, oh, buy real estate, no taxes, and I pay nothing. The joke is, by playing the true long game, I happen to pay probably more than my fair share of taxes. I pay a lot of taxes. And that's because I'm bankable, right? So anyone who's writing everything off or doing things illegally or whatever, I deposit all the funds in my bank account. I get audited by the local banks. In order to get leverage and scale your business, they need to see that you're paying taxes. If you're not paying taxes, you're technically not making any money. So I believe you got to pay to play. But of course, I get what's called the depreciation on the tax game. You can depreciate your single family homes over a 27.5-year basis. So if you paid, $200,000, you divide by 27.5 minus land costs, that's the value that you can write off against your income, which is beneficial in terms of, taxation, which is great. So if you've got a regular job, you can offset that income through the depreciation. So let's say you're making 8 or 10% on your rent. Technically, you're making more because you get the depreciation applied against your portfolio. And again, we're not tax advisors and we're all licensed. I would tell anyone to speak to your tax consultant, but that's the beauty of the depreciation. In addition, when you're holding these assets long-term, and let's say you refinance them, you're taking that equity, you're getting that equity to play with tax-free until you sell. It's a delayed game, and maybe you never sell, right? My exit is really not selling. So the beauty is, as these homes appreciate, you're getting that money, that leverage to work with, and it's pre-tax money, so it compounds much faster, and that's the beauty of this game, right? We're in full control. So that's super exciting. And additionally, if you're flipping a home, everyone wants that quick. Again, going back to the cocaine and sugar analogy, you flip a home and somebody says, "Oh, I just made $30,000." You absolutely didn't make 30,000 because of capital gains. You don't have the depreciation. By the way, you recapture depreciation. So if you were to sell, if you held that home for 10 years and you're almost halfway depreciated, and your basis, every time you write off that depreciation, your cost basis on that deal goes down. So when you go to resell, you're recapturing. The government says it's not like you're evading the taxes, you're just delaying the taxes. You're going to pay at that point upon disposition, upon sale. So everyone forgets that. It's always recaptured. But again, the 20% versus the 40% on average, if you're playing that long game and you held a rental for a year and a day and you sold it and you made 100,000 on that deal, you're making really 80,000, as opposed to if you flipped it and someone says, "I flipped it and made 30,000 in 3 months," you're taking roughly 40% off that 30. You didn't make 30, you made 18,000. That's a big difference. That's why, again, by stabilizing that delayed gratification, that taxation over 20% is a significant difference. And that's why equity is so key, especially, and this is what's cool. If Juan and I like the deal on Alex, for example, that home is worth 500,000 and I bought it at 400,000, there's 20% equity. If I sold it right away, I'm paying a lot in taxes. But if I'm delaying that, I've got that equity play, I'm saving $20,000. Even if I made 6 or 7% on the short term in terms of cash on cash, but I said, you know what, I'm going to play this out and I'm going to sell it in a year. When I factor in the equity at the end, I just made 25%. That's where these numbers get really fantastic by delaying and prorating and projecting those returns over the long term, recapturing equity along with the rental yields. That's where it gets super sexy.
And one other thing that I like about that is that, again, you're building wealth little by little. You don't have to pay those capital gains. And paying taxes is actually a good, because now you show that you're making money. A lot of people just deduct everything they can. And unfortunately, they're not able to buy anything because it shows that they're not making money, right?
Absolutely. So you see, I'm sure you see all these, "Oh, I can go online, so I buy everything subject to and no money and this and that." And I say, that's great, but when you're buying a lot of those deals, it's because there's no equity in those deals. So you're assuming someone else's debt, but you're also, what happens to your net worth when you assume that? Nothing. It's the same. There's no value in that. And in addition, to again be the full, live your greatest life without any restrictions, by paying those taxes, we can go to any bank. If I want to go buy a jet, or I want to go buy a boat or a car, and your lender's there, they can contest. That guy can qualify because he's paying the money, he's showing the income, you're doing it the right way, right? So those other people that are making all these assumptions, they can't go out and probably even extend a credit card because they have no credit, because no one's willing to lend to them because they show no income. So you think that you're winning, but you're really losing. You just think you're faster in the sprint. But again, playing the long game, I always want to start the race way ahead of the game, and that's what we're doing. We're doing it the right way, playing that long delayed gratification game.
Net worth is the most beautiful thing, because as you start using it and you start learning how it grows and you start applying it, like Zach says, just buying property with equity little by little, or building it equity, down in the long game, it's really, really nice. So awesome. Any other questions before we let him go? All right.
What
Adam?
about what about properties, rental properties, but that are being rented out as Airbnbs? What are your thoughts on that?
Great question. I've looked and I've even tried it myself, because I have a lot of friends playing that short-term game and the Airbnb and the midterms and all these different deals. There's a new one that came out. They take a regular home, they put 8 bedrooms in there. I forgot the name of this thing. I'm actually highly opposed. I'm very direct on that stuff. I don't like any of that, because I even tried Airbnbs. Here's why. Someone can affect your yield based on one bad review. Even though you have a perfect home, your jacuzzi, the temperature went from 102 and it's only 96, and someone wants a refund, and they put one bad review. I had a beautiful home on a golf course with the pool and the jacuzzi, and the pool was slightly green, even though it was perfect and I had a camera. and they write a bad review and no one wants to rent it. You just spend all this money on furniture. By the way, the barrier to entry for an Airbnb or these short-term rentals is absolutely zero. And your neighbor, anyone can make an Airbnb. So over time, there's an abundance of supply. Even Super Bowl, for example, in Arizona, the rental vacancy was 50% when you think it would be blasting through the roof, or you see, oh, I'm getting a much higher yield. I would guarantee that by the time you pay the overhead, by the time you factor in the furnishing, by the time you're managing the opportunity cost of your time to make sure that the towels are perfect and the home is smelling perfectly and the toilet paper is there, you're missing opportunities to buy multiple homes at 30, 40, 50,000 a pop when you're chasing, $300 a night. So for me, I would highly dissuade because again, barrier to entry is very low. Anyone can, there's an abundance of supply.
You like that penis, everyone? You like that big ass penis, you motherfuckers? You like that penis, everyone? That big ass fuck.
What is that? I think somebody hacked into your thing. Hello? Are you there?
That,
Somebody, I think, hacked into your thing.
yeah, they were trying to get in. Just don't let anybody in. And
There
then
you go.
report them.
There you go. So the bottom line is that was cute. Whoever did that, that's great. The bottom line is I would highly dissuade any of that short-term stuff because again, playing the long game, set it and forget it. Really focus on the acquisitions, then chasing that. Even if you make 10% more, what is the opportunity cost of your time worth? Right? That's really, really important.
Okay.
Does that make
Awesome.
sense?
It does.
Okay. It's easy to be enticed. Again, that's the sugar. Someone says, oh, I got this Airbnb and I'm making 300 a night. Okay, that's great. But how many nights are you vacant, right? And then when you really forecast it against the summer when no one's renting, what is your effective yield? What is your overhead? How much are your utilities? Because you're paying for all the utilities. People are blasting your AC in the summer. Are you really making that? The gross always sounds super sexy, but I really want to look at the net. What are you really making? If you're renting to a long-term tenant, they're paying the utilities. They're going to not have their AC at 60 degrees and jack your pool temperature up to 120 and then complain, right? So when you eliminate all that and all these other variables, again, controlling the controllable, you're good. Playing that long game and again, delayed gratification and having fun with it. I think at the end of the day, people get, intimidated by all this stuff. I always like to say having relationships like Juan and his team, we have a great time. Like it's just a good energy. I want to be surrounded. I'll never do an investment. I don't care if someone has $1 billion. Zach, I want to invest in you and you're an asshole and I don't like energy. I'm out. Find the appropriate people that you can enjoy the journey with, right? Where you, if you're playing a real game of Monopoly, you want to have fun with the people that are sitting around you. Same thing in the real world. Surround yourself with ethical, good people, having these mutually beneficial relationships, having fun and celebrating these wins. You do a deal, go out and celebrate it, right? It's a blessing. So, that's my thing. Having that positive energy and mindset and the people you want to affiliate yourself with and the people that are going to have your back, Frida. I think that's really critical.
Okay. Thank you.
For that. Yeah, I think the Airbnb game was like everybody's doing it, right? And it becomes dissolved. Like it's not, there was a saying back in the 30s, like when the shoe shine kid is selling stocks, it's too late. And right now, everybody's doing that. So the competition is huge. I went to a meeting. There was a wholesale meeting here in the West Valley. And everybody that was there that had properties in Scottsdale as Airbnbs, they were all complaining that there's so many of them. They're oversaturated and they're not making any money. So, right?
Absolutely. If you look and see, in fact, it's temporarily driven the price down in Scottsdale in that, McDonald, Hayden, all the way east to the 101 quadrant because there was of them. And that's what happens. The barrier to entry is zero. Everyone's like souping up all these homes. And literally those homes that were selling for 1.4 now, you could buy for 900,000 because all they were focusing on is thinking, oh, I'm going to buy that sugar. I'm going to get that quick, cocaine. And it doesn't work like that. It's going to work short term for, brief, but long term, when you forecast it out, they're done. These are just going to be regular renters or regular families moving in. And the people that are going to get rewarded long term are not worried about this little volatility, playing that long game.
Adam had another question. Go for it.
Yeah, actually, I had 3 questions. First question is, early on in the presentation, you said you're looking for about 8% yield. So you find that that's enough for maintenance and repairs I mean, that's like if you're paying $2,000 mortgage, you're making $150 a month. I don't know. It just doesn't seem like enough for the upkeep. I don't know. I'm just curious where you came up with the 8%, I guess.
Yeah, that's a great question. So I like to make between 8 and 10. Ideally, I like to make 100%, right? But the factor that you have to keep in there is the amount of equity in that deal. I wouldn't just pay for a $300,000 house, $300,000. I'm going to be in that house at 240, 250. So when I factor in, I'm stabilizing that equity. My net worth, what happens? I'm up fit. My net worth, if I go to a bank statement and I show that asset, my net worth just went up 50,000. Even hypothetically, if I broke even, you've got to make sure that you've got reserves. You're right. At 8%, and let's say cost of capital today, and you get a long-term loan on it at 7%, and you have $150 in excess cash flow. Remember, I'm paying cash, so it's a cash-on-cash return. So I'm not worrying about servicing debt per se. But you're absolutely right. If you have leverage on there at 7%, and you have $150, when you're buying these deals, again, that equity play is like you're cushioning your backup. But you have to make sure that you have reserves for if the AC went out and you're only making $150 a month. You shouldn't buy that asset until you have, $20,000, $30,000 in reserves or access to capital for a, unforeseen situation. But when we talk about contingency planning, you have to factor in, okay, let's just assume that the AC, the water heater, and some major plumbing problem arose. Do you have that liquidity to service that? Or do you have a home warranty for that contingency planning? If you don't put yourself in that investment until you're prepared or have access to that capital so that you can sleep at night. That's a very, very good question. You never want to be over levered. You want to be under levered.
Okay, thank you. Second question. What sort of resources do you use to find renters? And the second part of that question, are you allowed to put someone in a lease before you close on the property?
Very good question. So you can, as long as you disclose that it's contingent on your successful close, I can market that home. And you want to make sure that you get in writing. So good agent or yourself, if you're under contract, make sure that you put in your contract that the buyer is allowed to start marketing the home for rent with the seller's consent. Very important. You have what's called equitable interest because you've opened escrow. So you're going to have equitable rights to start marketing that. But it's always best, what's called statute of frauds, anything that could be a potential risk, get it in writing. A good agent will protect you on that and says, hey, Joe Blow is buying this home and has the ability to start marketing it for sale or for rent prior to close of escrow, and the seller agrees to allow this. There you go. Very, clarified and straightforward. So when you do that, you're good. What resources do I use for rent? Fortunately, word of mouth, putting yourself in rooms like this and telling people, hey, I'm getting this deal. I have hundreds of tenants, and thankfully we need to take very good care of them. I've got a waiting list of people, but maybe, the people don't want the area that I just bought one in Surprise or wherever. I have a bunch of young ladies and agents that will market them for me. Facebook Marketplace, Zillow's great, Realtor.com, and of course the MLS. So when you're going out fishing, you never want one line in the ocean. You want a net back there to get as many people as possible. So same thing, leveraging your own social media, leveraging your agent networks. And also I compensate, okay? So I don't expect anyone to do anything for free. I want to make sure that everybody wins. Obviously, I'm going to pay a large commission for an agent or someone who brings that tenant to the table that I'm verifying. And by the way, in today's market, I'm always requesting a month and a half security deposit because of, inflation, affordability. I've had a lot of evictions lately by a larger security deposit, verification of income, bank statements, and good 5-year tenancy. If someone just came out of eviction 2 months ago, there's zero chance I'm going to rent to them. Even if they prepaid me the rent, I wouldn't rent to them.
Quick question. What vetting process do you use?
Yeah,
for your tenant?
a full application process. There's you guys have access through zip forms to a rental application. I look at their credit. If they don't have credit, I will look at least their 5-year rental history. I will verify and have your agent verify in the tax records that it's very easy for a tenant who's a scam artist to put their best friend as their landlord and whatever. I want to go back and look, was that home rented? Is it registered as a rental? The person that they're paying rent to, do you have receipts to that person? It's easy. Once you delve into and take that next step, you're going to see, okay, this is accurate or it's not. By the way, let me see your bank statements. You say you work here. Are they paying you under the table? Are you working for a landscaping company? Or is this, what's your W-2 or your 1099? Show that to me. If they don't want to show that to you, these are all red, signs of scams. So I really delve into the application. I really look at that 5-year rental history. I want to know if there's any late. Did they pay late fees? I want verification of income. I want to see your bank statements. And the other thing is, it's just the human side of things. Did they show up when they said, when I'm giving them a tour, we're supposed to meet? Did they make an excuse? Did they confirm the meeting? Those are good things, little things outside of just the tangible paperwork. Are they respectful? Are they aggressive on the phone? Are they pushy? I need this right away. Or are they calm and relaxed? So once you really get into it, there's little signs and signals. It's like playing poker with someone. Is that person twitching because they're so excited they got pocket aces? Or are they calm and collective? Like, oh, I'm bluffing. You're going to be able to read people better the more you get into it. But look at the tangible stuff, but also use your intuition. A lot of times when someone is not looking you in the eye, they're lying. So, when they're talking to you and you're asking them these basic questions, are they, respectfully looking you in the eye? Are they looking down to the left or to the right? If they're looking away from you, they're lying to you.
That's awesome. And then with regard to the lease contract, do you stipulate on the contract that you'll conduct inspections of the property? And if so, how often do the inspections happen?
That's a very good question. On my contract, I don't. I use the Arizona state contract, which I always recommend. So whenever you go to court, it's not some unilateral contract. You don't need to create, everyone thinks they need their special contract to put all these crazy verbiage in there to protect you as the landlord. Because if and when, and it's just a matter of time till you have an eviction, you go to court and that judge sees some unilateral contract that's BS, it's not state approved, you're going to get yourself in a bind. So use the state regulated contracts. That is a good idea if you feel like you're nervous about the tenant. Landlord, by default, if you give a 48 hours notice in Arizona, you can access the home as long as you notify the tenant anyways. But I don't do that. But every time my maintenance staff, they're trained when they go in there to evaluate and report back to me. Hey, did they clean the filters? Like I put simple things in there. Tenant is responsible for light bulbs and filters and exterior maintenance and things of that nature. And it's important to use a landlord. You should be driving by the houses. If the grass is overgrown or there's weeds, it's a very good chance that the inside is looking as bad as the outside. And you want to put them on notice. Hey, I drove by, or hey, my maintenance man alerted me of the outside. We're going to do an inspection on the inside. And by the way, if you don't maintain the property, I will not be renewing your lease. And when you put those stipulations in there, there's a higher vested chance, just like going back to Section 8, they need to maintain the home. Otherwise, they can lose their voucher. So they need to have kind of an equitable interest in that rent, or else you're not going to renew. We're in the driver's seat. We have all the leverage in the world. And that's a beautiful thing to have. So that's a very good question. Yep.
Awesome. Anybody else? Questions? No?
Does you have any investments? Do you have any investments like in senior communities? How good are those?
Buying in a 55 plus community? Is that your question? Do I like the 55 plus communities?
If you have properties, how good, profitable are those?
How profitable are those? I would say they're equal, probably actually a little bit less than regular homes. We use the fishing analogy. When you're dealing with 55 plus, and I buy those, and I have a couple right now, and we're kind of getting out of that season because everyone left, snowbirds, etc. You're dealing with a smaller demographic. When I'm buying an investment, I want to appeal to the largest demographic, right? That's like saying I want to speculate on $1 million to $2 million homes. We're eliminating a large majority of the market. That's why I like the 450 and 500 and under without the 55 plus. I don't want to discourage you unless that deal is so much equity in there. That's great, and you can wait to sell it. But ideally, you want to appeal to the largest demographic, because when you go to rent that, you're only dealing with a small demographic. Versus my other homes, great. Even if somebody's 55 and they're taking care of their grandkid, they can't rent that home. So there's so many restrictions. Why do you want to buy a property that has red tape? Now, if you're living in that community and you have a huge sphere of influence and you know people that want to rent, and that's your niche market, then I encourage that. That's the exception to the rule. I don't live out there. I don't have a huge network of 55 plus. But if you or someone you're going to work with runs that market, or you run the community facility out there and for pickleball or golf, and you have a huge influence, then I would tell you go for it, because that's your sphere. But I'm not working in that sphere, so I want to focus on, again, what I can control in my network.
Awesome. Any other questions? Okay, one more.
So what's your take on a HELOC, and do you recommend for a novice to use that right away? Is that a good starting point for a novice to do?
I love HELOCs. In fact, a large majority of my business is based on, when you say HELOC, you're talking about a home equity line of credit, traditionally off of your primary home. Why I like a HELOC? It's just you're leveraging your equity, and you're not. The beauty of a HELOC is you're not paying interest on it until it's deployed. So you can be very patient when you find the right investment. I think that's a great tool. And obviously, if interest rates, get lower, you could simply just pay that back and refinance it out with traditional financing. So again, I never want to take a takeout loan on something or refinance of your primary home versus the HELOC, because of the timing aspect. It enables you to really slow down, find the perfect investment, and then once you pull that money, the clock starts, versus a takeout mortgage where you feel like you have to quickly deploy the money to offset that interest expense. Even if you don't have anything, you're paying money on sedentary money on a regular takeout. So I think having the HELOC, having that liquidity, you feel such in a good power position to really take your time and leverage it to the highest level without that interest rate clock expense in the back of your head ticking. So I think it's a great tool. You just need to be cognizant, because right now HELOCs, if you're looking at them, they're tied into LIBOR and prime. They're probably 8.5%, maybe 9%. So you just got to be very careful that you're buying deep deals that can offset that interest expense.
Guys, you want to clear that out? Awesome. Anybody else? Any questions? One more.
So my question was, going back to what you said, that you like to walk every property before you close on it. Have you ever bought a property out of state? And if so, did you have like someone walk it for you, or did you do it yourself?
Very good question. And I've coached students nationwide. The answer is no. I would never do that. Because again, I like to say this: when you go and order an In-N-Out burger, you don't need to walk inside that kitchen and inspect the kitchen, because you're buying a burger and it's $6, $7. Now with inflation, what, an In-N-Out burger's $10, whatever. If the burger wasn't good or it's overcooked, you throw it out, you move on with your day. We're talking about hundreds of thousands of dollars, maybe even more. Trust nobody, right? I don't, there are a lot of scam artists out there, even a friend of a friend or someone, even potentially a family member, unfortunately. You have to, I encourage you, I implore you, do not buy out of state, because it's going to be tough to manage that. If the maintenance person knows you're out of state, knows, oh, I just replaced your condenser on the AC and there's nothing wrong with it. These people are going to be milking you for the whole time, especially when they know you're out of state. Do your due diligence, walk these properties. If it's not accessible, don't buy the deal. Hundreds of thousands of dollars on the line. This is hard income. These are years of, regular income, your jobs, that you're willing to just offset for a 5-minute decision. No way. When you look at the macroeconomics of that, it just doesn't make sense. So I've never bought out of state. I've never bought sight unseen. I take it back. I bought a lot of deals from people that I know extremely well, that I have leverage over them because I'm their largest borrower, that with good videos and pictures from them here, only after years of experience and deals with them, have I bought. And if there was ever a problem, I know they would make it right. I don't recommend that. Candidly, I'm always transparent in what I do. You got to walk every property. You got to see it, hands down. Period, the end. Because if someone's taking pictures, they're only showing you the highlight reel. They're not showing you the structural crack or the settlement or the lifted shingles in the corner. They have a vested interest for you to buy that deal. It's it's not a cohesive relationship at that point. They're operating for their best interest. They want the most out of the deal, and you want the cheapest. So trust nobody, walk it, and do not buy out of state. Buy locally. Period, the end.
Awesome. One thing I want to get out of this, and I feel your confidence when it comes to the deals you've done. I mean, the years of experience you have in this business have taken you and got you to where you're at. So when you guys are out there doing this, especially if it's your first or they're your first deals, make sure you guys get good advice. Because like he said, any seller is going to tell you that everything's great, right? And make sure you guys do your due diligence. Again, use professionals. That's why we're here, right? And we have great connections like with Zach and his group to get great deals. So if you guys are open to looking into that further, just let me know and we'll talk about it. Deal? Thank you, Zach, for joining us, man. This was awesome. I appreciate you.
I'm honored to be here. I appreciate you. And I work with thousands of agents. You guys in your group are the top of the lines. I'm no vested interest. I don't get paid to be here. There's no like affiliate or anything else. Juan and his group are the real deal. His energy, his transparency, his honesty is top notch. So I welcome and I'm grateful to be with you guys in your group today, and I would endorse you to anyone across the world. So thank you for the opportunity. I look forward to doing more deals with you and your clients, and grateful to be here. I appreciate it.
Thank you. I guess there's one more question before we go. Go for it.
Hey, Zach, on your exits on any of the homes that you sold and you want to get rid of, have you ever used a lease to own option?
Great question. Yes, I have. And I definitely don't recommend it based on my experience. And also someone who's doing seller finance. I don't also recommend that per se, because we're losing, once you seller finance, number one, you're no longer on title, so you no longer get the depreciation and your tax, and you can't leverage that investment, right? It's going to be tough. You could sell those notes, right, if they're good performing notes, to buy into another deal, and it might be a good yield. But really playing the long game, I think you're going to be better off by just holding those assets. But again, to each his own. I'm not knocking it, just things to think about. I highly dissuade you doing a lease purchase from my personal experience, because when the market exploded, let's call it from 2014 to 2016, or even from 2012 to 2014, we saw massive appreciation, right? What do you need to say to yourself when you're giving a tenant an option? And I give my tenants options to buy, but I'm not going to set a price by a 5 or 10 or even a $15,000 down payment. And the reason is this: that 5 or 10 or 15 does nothing for you up front, right? It's not like, wow, that's changing your life. That money is not monumental. And then you're restricting your upside potential, because if that home went up 20% or 30% in a year, which we saw, I gave a lot of people options for $5 or $7 or $10,000, which didn't move the needle for me when I did it, right? Even sometimes that money was held in escrow, so I didn't even have access to that money. And all of a sudden I gave them an option to buy that deal, let's say at 250. And by the time they exercise that option, that home is 350. And I left 100 grand on the table for 5 or 10. I look like a fool. So I would tell people, instead of, you could say, hey, people want to do a rent to own or lease purchase, that's fine, but make the terms as follows. I'll give you the right to buy it as long as a mutually agreeable price between buyer and seller. Don't take any money up front, and don't restrict yourself, because that option money is only unilaterally much more beneficial for the buyer than it is for you. So don't restrict yourself, because if that home, we have some great interest rates drop tremendously and you really want to exit and that price skyrockets, you're leaving tremendous money on the table for nothing. So just be diligent when you're structuring those deals. Take it from me, who lost hundreds of thousands of, I didn't lose, but I left because I still made money on the deals, but I left hundreds of thousands of dollars on the table. I think I did 4 or 5 of them in a massive appreciating market, and literally left $500,000 on the table for what, $20,000? That's a fool's move. So that's a very good question. So structure it appropriately for yourself, and make sure that you have an exit. If it doesn't appraise at a certain value, then you have a unilateral right to wait longer for the buyer to hit that minimum. So again, Juan and his group can make sure that you're putting the proper verbiage in there to give you the full protection on your exit.
Awesome. Thanks, guys. Thank you, Zach, again. I got a lot from you. I mean, long-term game. Do your due diligence and get around professionals.
Yeah, have
one more
fun with that. Play the long game. Go ahead.
Hey, good morning, Zach.
One more.
So as you grow your portfolio, right, starting out, what do you recommend for somebody starting out? Is it always a 20% down, hard money loans, refinance out of them? Like, what's the best way to keep it stable? And I guess make it where you're not really spending a lot of money every time you want to buy a transaction with, your traditional 20% down. How do you come about your financing? What's the best way?
That's a great question. Definitely, if you're buying and holding these, hard money is probably not going to work, because your burn rate's going to be really high and it'd be tough to keep up with that. Again, buying good deals when you qualify with leverage. I don't know what your career is, but I would first leverage your, existing income, your 9-to-5 job or whatever you're doing, to get the cheapest rates possible. And once you've utilized your own capacity of borrowed leverage, I would work the OPM model. So that way you're not hemorrhaging money and you're worrying about it, by having a good strategic partnership with a high net worth individual or people that have passive income that can invest in you, and you've proven the model. I would probably prefer you to go that route than just getting over levered, and 20% down here, you're going to run out of money pretty fast. So if you got potentially unlimited capital from outside investors, and again, you're the workhorse on the horse, you're going to do extremely well. You just need to structure those investments mutually beneficial. Again, play the delayed gratification. Even if you made nothing for a year or two, but you're buying a good deal and it's going to appreciate and you're going to get paid at the back end, I do those deals all day long. I mean, I just actually sold one from an early investor from 15 years ago on Malapai with a guy named Frank Navarro. Done multiple deals with the guy. I sold that one and I took nothing. I let the investor take all the rental income. And when they wanted to sell, we set a time frame. I literally made 100 grand. Who wouldn't want to wait 5 years effectively or 10 years and you're making 10,000 a year by setting it and forgetting it? Playing that long game is a perfect example where I'm not just worrying about the $100 a month cash flow. Who cares about that? Because if you forecast that and I made 100 grand on that deal waiting 10 years and got paid nothing, I'm happy to do that. That was a wonderful payday of, again, delayed gratification. So when you structure the deal favorable for your investor, but also knowing that, at the very end of that race, you're going to get rewarded, there you go. So structure it accordingly and just be diligent about that. Find the right partners that want to invest in you in the right time horizon.
Awesome, Zach. I guess one really last question. With regard to the younger crowd, we love here at the Grimaldo Group, we love working with the younger crowd. And one of the things that I like mentioning to the younger crowd is if you're still living with mom and dad, or maybe you're not, but if you can start buying your primary home, make it simple, but get a primary home and figure out a game plan where 2 years from now, you can potentially rent it and buy another primary home. Is that something that you would consider, or is that not a good strategy to do? Because I just see that sometimes someone can get a primary home at the lowest possible out-of-pocket money, and then use it as a stepping stone to get to the second property, which in turn will be a primary home, and the first one be a rental, and so on and so on. After 10 years, they could have a portfolio of houses if they continue that.
I think that is an excellent strategy, of course. And when we talk about these young people, it's certainly really important to talk about their time horizon, right? They can stomach risk. They have longevity, right? I mean, someone who's 18, 19, 20, 21 years old, they're going to be in this game for, another 60, 70, 80, 90 years, God willing. So it's a huge time horizon. And I think that I'm seeing a trend with these young people going out to buy the home, and the first one being a primary. They're living with mom and dad. And what they're doing is their friends that work jobs and they're making $20, $25 an hour, they can rent out those other rooms. So I would get a minimum of a 3 or a 4 bedroom. And then they want to live with their friends and make it a fun experience and have the friends technically pay down the full mortgage payment. That's a great position to be in. And then again, in 2 years, and that person's living in it, and you're living for free. You're living with your parents for free. Now you're leveraging your income and you're leveraging your sphere of influence with your friends, and you're renting out the rooms that effectively probably even positively cash flow. Even if you broke even, it's great because you're paying down principal. So again, you have to factor that. Sometimes people think, oh, my cash flow. Even if you're servicing the debt, but you're paying down principal, you're still making money. You have to factor that in, which is key. I love that strategy. And then in 2 years, you find another one and make that your primary and keep rolling, and going from there. So I think that is a very good idea. But again, it's an incremental thing. No one's going out and buying 10 homes at once. Start with one, proof of concept, get the, friends and family in there, and then go on to the next one. I think that's a great idea.
But awesome. Thanks again, sir, for joining us. We're grateful. Sort of a little mishap in there. We'll make sure it doesn't happen again, but.
Oh, that was funny, right? Like you can laugh at it. That's just like anything else. Like
it's crazy. A little break in between. Let's go.
Whatever. It's funny. Who cares? Next. You can't let little things bother you. That's for sure. It's like an AC compressor went out this morning. No big deal. Next.
Definitely. Thanks again, Zach. And
great to see you. Have a wonderful weekend. If anyone needs to connect, you can give them my IG or anything else. Happy to help and serve. Have a wonderful, blessed weekend. Appreciate you guys. Great to see you.
Thank you, sir.
Take care, guys. Have a wonderful day.
Thanks. You too. God bless.
You too.